Welcome to Top M&A Entrepreneurs. Today, my guest, John McNabb, and here to talk about words of wisdom, raising equity injection or capital money for your acquisitions. John's bought a number of dental offices. And what are your words of wisdom about purchasing an SMB business needing a big, fat equity injection?
Well, John, first of all, thanks for having me on. Good to be back with you. The healthcare world, where I focus a lot of my time and attention and activities, is a little bit different than other parts of the business world. It's less cyclical and more of a darling, so to speak, in the eyes of both lenders and equity funders. Businesses in my sector perform better, they're recession resistant, et cetera, et cetera. Profit margins are high, EBITDA numbers are good. So even in the kind of environment that we're in now with high interest rates and a softening economy, we still do well in the healthcare sector, particularly in dental. So what does that mean in terms of raising capital? Well, the basic lesson is the same. Raise capital when you can, not when you have to. What does that mean in practical terms? When you can is when you're doing well. When your business is running well, when profits are up, EBITDA numbers are good. Remember, banks and VC and PE money look for EBITDA. That's a metric they look at all the time. When profit numbers are good, when you're growing, people will want to give you money, lend you money, invest money as equity when you're in good shape. Now, you may not think you need it, but if you can build up a war chest, if you can arrange a standby line of credit at the bank and pay a little fee to have access to $1 million of credit so that it's available when you need it, if you can arrange a home equity line of credit and have a couple of $100,000 sitting in your hip pocket that you can use as a down payment on an acquisition when you need it, do those things when you can. Because when you actually need it, 9 times out of 10, those scenarios are when things aren't going well for you. The economy has weakened. Your business has flatlined. You aren't growing anymore. Your profits are down. EBITDA numbers look like shit. And nobody's going to lend you money or invest equity in you. So when you need the money, you can't find it. It's the old saying, and everybody knows this one. Banks will lend you money when you don't need it, but they won't lend it to you when you do. I know that one from the other side of the desk because I was a banker for 20 years. So where does that lead us in terms of making financial decisions about raising capital? And I'll translate that into the healthcare world for a practical example. The healthcare world has not been immune to the effects of increasing interest rates, both in terms of business valuations, which have softened in some cases considerably over the last 18 to 24 months, since interest rates started to go up, and also in terms of cash flow, because those interest rates are eating up a much bigger chunk of cash flow now, just to service whatever debt you have. 18 months ago, when interest rates were at rock bottom levels, just starting to rise, you were spending maybe 2%, 2.5% of your cash flow servicing your bank loan on your interest payment. Now you're spending, depending what kind of debt you have, if it's bank debt and you're a prime +1, you're over 8%. If you've got an SBA loan, you're in nosebleed country. You're in 11% or 12% or something up there. That's a big chunk of money that goes out the door that you have no control over. So what's happened? Well, prices have gone down and appraisals done by professional brokers and business valuators in the industry reflect that. Appraised values of healthcare practices, dental offices, veterinary offices, medical practices, optometry practices have all declined. But sellers are holding out for the values that they got or they saw their friend get a year ago. There's a disconnect there now in the market between what the seller wants to get and what the buyer is willing to provide based on the appraisal they just received. So what happens? Well, first of all, sellers are offering seller notes now much more commonly and in much larger amounts than they were a year or two ago. That's one way of trying to bridge that financing gap so the seller can close a deal. Sometimes those notes implode or explode, whatever word you want to use in the jargon, meaning some parts of them are forgivable over time if targets aren't reached. But seller financing is part of the matrix now. The other issue, which is a big issue, is that with appraised values down, institutional lenders and VC or small end PE players lend against appraised values, or they provide equity against appraised values. They don't provide money against thin air. So they look at the appraised value and it's underneath what the seller wants in terms of purchase price. That gap in there has to be funded. And in most cases, the seller notes aren't sufficient to cover the whole gap. That means that the bank or the VC fund or the PE fund will provide maybe 85 or 90% of the appraised value, but you as the buyer have to come up with the other 10 or 15%, plus you have to come up with the gap between the appraised value and what the seller wants. That can be a big number. That's why you need to have the reserve fund. You need to have that rainy day war chest that you raised when times were good, when profits were high, when you could raise the money, so that when you need to make the down payment, when you need to finance the operating shortfall for a period of time, or if you have a shortfall on your accounts receivable funding from the bank, or your inventory financing has a bulge facility in it, and because your sales are softening, your inventory is building up because you're not selling as fast, you need to have capital available of your own that you can cover those anticipated shortfalls from. So we're back to the simple thing. Raise your capital when you can. Have it in your hip pocket. Have that ace up your sleeve so that when you need it, you can bring it to bear to solve whatever problem you have, whether it's a down payment on a new acquisition, or whether it's funding an operating shortfall on a temporary basis, or whatever it may be. You're not going to get money in the market when you're in difficult times. You'll get it when you're in good times.
Gold nuggets. Thanks, John McNabb. Let me stop that.